Radium Capital, a clever part of your capital and cash flow mix.
Okay, the webinar is now broadcasting to all attendees, and the room is currently filling up. We'll just wait probably a few minutes before we kick off. How is everyone?
Good. Yeah, good.
Thanks, Sam.
Yeah.
So we're currently spread between 3 cities. Perth, myself, Cameron's in Melbourne, and I think the rest of you are all in Sydney. That's right?
That's true. Yeah.
That's right.
So all adjusting to the new normal?
I think so. It's definitely changed, that's for sure.
It's weird when a month feels like a year, but I think it doesn't feel that awkward. It doesn't feel that awkward anymore. But walking through Sydney does feel awkward when you still see it empty.
Well,
I miss yeah.
Photographers will have fun at the moment, won't they?
Yeah.
It's going to be weird going back to work. It's going to be like, oh my God. Human.
I normally work from home, so yes,
Okay.
but I normally don't have the kids in the other room. Yeah. So anyway, we've got 50 people in the room at the moment, so might be an idea if we just kick off. I'll do a little bit of an intro. Thanks everyone for coming along to the first Techboard Roundtable minus a table that isn't round. We've done 5 previously, also none of which had round tables, but we had people sitting around the table. It was a concept I stole from comedian Alan Davies, who did his session where he had a few mates around a table chatting with an audience in the background, and I thought this is a different take on a panel session. So I tried that out and it worked fine. Everyone tended to have a beer or something in their hands because we ran them in the evenings, but I've got water here. I hope the rest of you are sorted.
Yeah, beer is a bit aggressive for 10 a.m.
Just water at this stage.
Yeah, so look, I mean, the reason that Techboard has been doing these roundtables is essentially Techboard started off with an objective of promoting startup and tech companies, initially focused in WA, and then we went national. And we were collecting data to help us run the Techboard ranking, which enabled us to publish a list of the extent to which companies were trending. We couldn't monetize that model and focus down on the funding data, which was nobody else was doing well, and most of the providers, their rates are so inaccessible anyway. So we focused on funding data. So we've been tracking the growth of the ecosystem since 2017. Most of our customers are government. We are opening up a few products that I'll tell you about a little later, maybe. And so I normally start these sessions with a bit of a presentation. I'm not going to do that today. We don't actually have our data ready for the March quarter. And what happened up to December seems somewhat less relevant than it used to. So the reason we do these is to let people know about Techboard, but also to give back to the community, which seems even more important at the moment. And all of our events have had funding themes, the future of funding in WA, then did one nationally in Sydney. We focused on fintech in Melbourne, and I've done a couple of extra ones in Western Australia focusing on how do we get more VC into WA because we don't really have much. So there's been some great sessions. Innovation Bay put on a session with 4 venture capitalists talking about what's happening now. And I thought, well, there's a bunch of other funding types apart from VC that may also have been impacted. So I thought it was a good idea to try and get some people together around the table to have a chat about that. So this is our version of sitting around the table. We don't have the same we should have actually organized this to have the same background behind all of us. Maybe next time. Make it look like we're in the same room at least. That's a great idea, actually. Anyway, so what I'll do is, everyone's seen the promotion of the event, which gives a very brief outline of everyone. If I could maybe get each of you to briefly introduce yourselves, and maybe a brief outline of the funding type you sort of represent or you deal with regularly, and then we'll get into more of a discussion on how the current environment is impacting on that. So maybe if I could ask Cameron to kick off.
Absolutely. Well, thanks Peter for organising this event. So Cameron Owens is my name, CEO at Radium Capital, and what we do is provide an early payment to businesses for their R&D tax incentive refund. So that's us.
Cool. Well, next on my screen at least is Steve. So
Steve Torso, co-founder of Wholesale Investor and CRIISP. We basically work with growth companies to match them with high net worth and family office investors across Australia, Singapore, and UK.
awesome. And Jehan.
Hi. So I'm the deep tech lead with KPMG's High Growth Ventures Group, and I'm a subject matter expert in R&D tax, grants, ESIC, ESVCLP schemes, and various innovation schemes that are associated with the government. So yeah, mostly we work with startups and founders as a founder-first organisation, looking at how to access various R&D and grants schemes.
Cool. Lynda.
Hi. Look, thanks for having me, and I really enjoyed the last roundtable that I participated in. I guess I'm here today on behalf of Scale Investors. I sit on the board there. I'm also an angel investor with that group. It's syndicated investment. We're a group of angels, largely Melbourne-based. However, we do have a group of angels that are in Sydney and a little bit scattered broader than that. I guess our investment focus is specifically on female founders. That's our sort of overarching investment criteria. Otherwise, it's sector agnostic and obviously focused on that first external capital raise.
Cool, awesome. And last but not least, yes, everyone else. Yep. Nick, you're currently muted. Oh, yep, I'm muted. Cool.
Yep. Hey, I'm Nick Gainsley, One Ventures. So I head up our venture debt fund. One Ventures, if you don't know, is a venture capital firm based in Sydney, Melbourne, and in Brisbane. We're at 400 million under management. Historically, we've been a pure equity fund, but most recently we launched a venture debt fund, which we started a year ago. So effectively, we're providing loans to high growth tech businesses across Australia and New Zealand, really providing an alternative to equity to help scale their businesses.
Cool, awesome. Now, I'd like to...
Pete, you forgot me.
Oh,
Johnny!
John, sorry.
I spent the entire
Took your book in the
life at the end of the
background.
alphabet. Yeah.
Yeah, Johnny.
I've always wanted to change my surname to start with an A or a B, but yeah.
I need a wider screen because I didn't have everyone on there.
Gotcha. Thanks. So I'm Johnny Wilkinson, co-founder and managing director of Equitize. We're an investment platform for unlisted securities, and we principally do it through equity crowdfunding and wholesale raises.
Awesome. Okay. So getting on to the impacts that the current environment's had. Now, to what, I mean, maybe I could just ask this question and anyone can jump in. So how's the current environment of the pandemic impacted startups' ability to access funding?
No one's
Bit of
going
an open.
We've had Dorothy Dix on that one. I'll have a crack to start off with. I think it's pretty obvious that access to capital's very much tightened. It's unsurprising, isn't it, when you're going through something as large, as impactful as the coronavirus. So we've definitely noticed that the ability for startups in particular to access the traditional sources of capital has become more complex than otherwise would have been.
So yeah, obviously when there's volatility, uncertainty, people hold off on making investments, particularly in illiquid assets. unless they're getting a screaming deal, which is sometimes hard to work out what is fair value. We had 3 deals close roughly 3 or 4 weeks ago. And the normal sort of pattern as to what we'd get in the last 20% of the time we're raising money was probably about half of what we'd ordinarily expect. So that was when things were starting to come off in equity markets and some of the uncertainty was growing, and volatility was increasing. Look, it'll just be a matter of there's going to be more competition, it's going to be harder, and you just got to be really focused and able to articulate what you do and what you do well as a business to attract funding.
Yeah, I think the biggest thing that people will see is that investors will just they'll be investing into companies that they're more aligned in, whether it be for strategic value or if you're dealing with high net worth, their relevant how active they're looking to be with that company will play more of a role. The challenges you'll find is that the sort of gambling or the punt money where people just sort of, had an interest and they just thought, they'll gamble sort of 50K, 100K on a bit. That money unfortunately disappears, but that used to be the money which would help a company with sort of momentum in their capital raise.
How are you finding that, Lynda?
Look, I think these times are challenging whether you're a listed corporation or an early stage startup. I think there's uncertainty across the board. For an early stage startup, raising capital, of course, it's challenging at the best of times, but I think it's challenging now because you have investors that are risk averse and want to hold on to cash. I think you've got a customer base that's risk averse. So in terms of being able to, when you are raising capital, to be able to say, oh, well, look, this is my go-to-market plan and this is my customer acquisition, etc. So it's really difficult to articulate. One interesting thing, though, I would say is with our angel investor group, we haven't really seen a lot of attrition. We've still got deals in flow. And if anything, actually what has been surprising to me, but also good, is we've had a lot of prospective angels, maybe because they've got time on their hands, actually getting in touch and wanting to join our virtual, we have moved to virtual pitch forums and information sessions, etc. So that's promising. But look, I think there is an overarching scenario of where people are a little bit less ready to put their hat in the ring than previously, and I think that just comes down to the uncertainty of how this will play out over the next months.
So the sorts of investors that have been approaching scale, are they similar to your existing membership, or are they higher net worth, lower net worth? And do you have any sort of gauge on that?
To our existing base. I mean, obviously in our existing base, we have some investors that are quite active, some that are passive. I mean, the group, they need to be sophisticated investors to be part of the group and actually invest. So that's sort of a minimum bar. Yeah, I would say very similar to our existing base.
Okay, cool. Johnny.
Yeah, and I think I was going to say that it also depends on where you're playing in the market. So if you're a startup and you've done a small angel round and you're really looking at a sort of a second angel or a seed round, if you've actually taken your product through a lot of validation and you have potential sort of corporate partners, if it's a B2B business, or you've demonstrated that some kind of traction, you'll be able to land those deals. It's kind of the more speculative businesses, I suppose, and so the messaging to founders is work on the validation and work on getting support, even if it's in kind, to sort of to shape up the business model, to really understand who all the players are, to even do some prospective deals, and there are companies, even groups like Bruchem who are huge. The way that they demonstrate validation is through forward deals and forward contracts, and effectively monetizing, sending out a device on effectively a loan basis, and being able to show that yes, this device is getting traction within a potential partner, where there might be a potential deal, and then, you know, sort of build a narrative from there rather than just go, here's an idea, I'm an expert in the space, fund me. It's kind of like, well, yeah, just it's requirement to do a few more hard yards.
Pete, I think the thing just to highlight for investors, this is something that some people have been waiting for a decade as far as a market opportunity goes, because obviously for them there's less competition from their perspective, and they've got more ability to actually negotiate, more ability to add value. So, you know, as much as everyone's talking, yes, there's less from the investor's perspective. This is effectively becomes their prime time. And, you know, I said we had the experience of launching in the GFC, and that made a big difference because we didn't see, okay, let's go back 3 months ago. We didn't see those type of market conditions till like 2013, 2014. Everything before that was strategic money. In fact, every media group was talking about how there's no funding for startups up until that sort of 2013, 2014 period. So this is sort of not new. It's just that the only difference is there's going to be 5 to 10 times the amount of companies going to raise money in the next 6 to 12 months than whatever has before. That's what's going to be the challenge. Yeah.
Pete, one of the things we've noticed is that the importance of the R&D tax refund is growing for businesses, so they value it even maybe more than what they have had historically. And one of the byproducts for us is that all of a sudden actually getting an early payment on your tax refund is maybe more important than it once was, particularly those businesses that are just wanting to just strengthen their balance sheet and capital position. So for us, nothing's fundamentally changed, and we're just seeing a lot of people gravitating towards just shoring up their position on their R&D tax refund, as well as looking at whether they can get an early payment on it as well. So it's for us, there's growth. We're seeing growth in the market for our type of capital.
Yeah, and we're also seeing a focus in product development. So a real, a pivot away from, marketing. I mean, maybe a little bit of branding, but less from marketing and sales, and straight into product and validation. And so that obviously increases the quantum of R&D, and then the quantum that gets returned. So it's obviously a lot of these companies have done the financial modeling around that and determined that that's the way that they actually extend their runway by a couple of months.
Yeah, correct. Yeah,
it's actually a good point. Like this is one of the rare times where I think from a company's perspective, like usually when you think about capital, you're just thinking about equity raises. But obviously you mentioned yourself, Cameron, in that, companies can get access to their R&D financing earlier. There is obviously the option for some companies, obviously not for sort of seed stage startups, to get access to potentially debt funding as well. You've seen investors on LinkedIn talk about how they're sort of being more open to the idea of potentially convertible notes with companies, understanding that their companies are going to be impacted. I think from a founder's perspective, if you already have shareholders, this is normally it's the, how could you have always done better? Where this is a nice time where shareholders are actually really getting behind their investee companies to support them. So I think for any founders listening, start with your own shareholders, because it's amazing the networks they may open up to you as a starting point. And also, so the R&D financing is one part, debt is another part. We had our EMDG grant paid out early. That was fantastic. And if the government decides to do that with R&D financing as well, that could also be another mechanism.
Okay, so
just to add to the points made, I was going to add in terms of like what you see in this market. I mean, there's a question of what sort of investor you're seeking, and kind of how they view the market and allocation they have. So, committed funds out there, and talking from a VC perspective, if they've got allocation of money available to invest, then clearly they still want to, and they're looking to invest in the market, they can still invest into the space. But like everyone's saying, they're more selective. Whereas someone who is more open to different investment channels may say, look, venture is not something, tech isn't something I want to invest in. So that's a big impact. And talking from a debt perspective, obviously, from a lender, it's a different risk profile than an equity investor. So from our perspective, look, we're still really active in this market. We'll see good opportunities in this market and happy to lend. You haven't got to approach the difficulty around valuation, which is a bit of a kind of elephant in the room. So taking debt, you avoid that conversation. But of course, even someone like ourselves, people are still conservative in this market. People are looking, well, sectors very exposed are going to be super cautious. But it's not just kind of the COVID-19 piece, it's kind of what happens in terms of longer recession and recovery in the market. So.
Okay. So in terms of the way you guys are all operating, eligibility criteria, to what extent has what you're looking at changed over the last relatively short period?
Well, just say from a Radium perspective, nothing's changed at all for us because we're obviously lending on the back of someone's R&D tax refund, so that program remains as is. So if anyone's eligible for a R&D tax refund, then they're eligible for getting access to our funding. So for us, we're somewhat sort of quarantined from, I guess, the broader market challenges at the moment.
I'd say from our side, and I imagine Johnny's probably experiencing the same, like it's a really weird thing where you look at the news and you see all the different statistics, and then every day we're speaking with founders and investors that are optimistic. There are founders that this market is a golden opportunity for them. They're the ones that typically will start to sort of stick their head out of the sand and really become more proactive. So from our perspective, if anything, I think it was over like a 2.5 week period, we had something like 80 inquiries coming in through to the company, and not one of them was pitching the angle of desperation. That's why they were raising. It was more opportunistic.
So off that 80, how many of them would have been, okay, this is an opportunity that's been opened up because of what's happening in the market, or this is an opportunity that doesn't seem to be negatively impacted by what's happening?
Correct. It was a combination of both. Not sure exactly what the percentages were, but definitely the factor of both, where they don't really see it as impacting their business too much. And the other one said, look, for healthcare related companies, they're obviously seeing it as a window of opportunity, and also obviously for some tech companies as well.
So, Johnny, what are you seeing with companies looking to start campaigns?
Yeah, good question. So much like Steve, we're seeing companies come through that this is now an opportunity to go to market, particularly if you've been sort of honing your model, or you've really kind of hit a groove and you were planning on going out to market. People are trying to act quickly, which, if your business is solid and you have a very good understanding of how this might impact the next 3, 6, 12 months and thereafter, and you can articulate the investment opportunity, then it is a good opportunity for people. We have had some people kind of approach us and just be like, we want to raise money because we want to raise money now before it dries up. Those sorts of companies we've sort of sent back and said, that's great. Seemingly your business is doing well, but how does this impact your model? Come back and sort of show us your flex sort of scenarios and how this impacts your unit economics, and how can you reduce expenses? How can you focus on servicing your clients as best as you can? How can you increase your yield, or how can you increase your margin on whatever you're doing? How can you come to market with an investment and say, we have a degree of certainty that this part of our business will continue, this part might be impacted, and this is another opportunity that we're looking at. So it's varied, and some of the sectors coming through will obviously have greater scrutiny, and people will be more cautious around investing in certain things. If you're counter-cyclical or in a defensive sort of sector, then obviously it's a good opportunity and easier to stand out. So it just depends. As is always the case, we see lots of companies across different stages and sectors, and looking to raise different amounts of money. At the end of the day, you just really need to be able to go out and clearly articulate to potential investors what you're doing, where it fits in the current market and climate, and what the future looks like. And if you can handle that, and if you can understand what that impact is going to be, and be very clear to investors, that gives people certainty and a bit more confidence. and that's when people are more likely to open up their checkbooks. You know, we've held off. We've got a couple of deals we're about to launch because the single biggest impact to what we see is volatility in markets. When there's volatility and uncertainty, people just hold off in making investments. They wait for it to die down. So yeah, when markets sort of settle a bit, they're already starting to. So unless we have another bit of spike in volatility, we're going to go to market with a couple of companies in the next couple of weeks and get a bit of a sense of where things are at, and then assess the pipeline thereafter. So,
staying with Johnny just for a moment. When were the last ones you closed? Were these the ones 3 or 4 weeks ago you mentioned?
Yeah, so we had KitFit, which is a new online SaaS for retail that does both contextual and sizing fit. So effectively, any online retail, you plug it in and it will basically scrape your entire platform and all your SKUs, and then anyone looking to interact, it will give them only both sizing and contextual fit. So is it suitable for what you intend it to be used for, and are people like you wearing it or using that product? And more importantly, is it going to fit? Is the medium in this brand truly the medium you think you are, or should you be a large? That went well. We raised about $500,000 for those guys. We had Food to Nourish, which is a organic food retailer, producer. So they do, you know, your paleo bars, your vegan and organic friendly sort of health food snacks. Two ladies run that business out of West Gosford. It's been growing. They've seen a great uptick. They went well. We raised them about $400,000. And then the other one we had was a wholesale deal for Zinger. It was a part of their 50 million round, which then got expanded when they took on the investment from the R&D Investment Group.
Okay, so you haven't seen, so that was what, 3 or 4 weeks ago, and these new ones that you're going to be putting out soon will be the first test you'll have on, are the investors still interested?
Yeah.
Okay.
So, you know, the sense we've got and the expressions of interest and some of the interaction we've had shows, you know, that there still is a lot of people out there looking for investments. I think it might just be when time comes to make the investment, they might not invest as much, or they might scrutinize some of the investments a little bit more than they would have otherwise. So yeah, we're just waiting to see.
Okay, so I've had a question come through before the session started on due diligence and how long investors are taking to make due diligence decisions in the current climate. Whether there's a hurry to get money into certain companies because of the market opportunity. What are people seeing there?
I'll just highlight the deals that you're seeing promoted in the media now. I think everyone just has to be realistic to understand that those deals were worked on before Christmas, not after. You know, it takes months for, you know, when you're talking about deals that are in the sort of 2 to 5 million range to be completed, it literally takes months, you know, and anywhere from 3 to 6 months to get those sort of types of deals across the line. The actual due diligence question one is interesting, because the question that got posed to me was how many VCs have made investments into companies that they've never actually physically met before? And that's the question no one can answer right now, you know, and you're unlikely to see an answer for at least sort of 3 to 6 months, you know. So to me, that's an interesting one. And you got like the due diligence process is typically longer, you know, than a sort of 3 to 4 week period. So it's sort of, you know, in same with what Johnny said, it's sort of hard to know until you get sort of 3 to 6 months down the track as to what the real impact is.
Yeah, I mean, we were talking before we went live. You know, we are in 3 cities, all in the one place. And, you know, I'm based in Perth, and I attended the Innovation Bay session in Sydney that I wouldn't have been able to get to otherwise. And this is the new face-to-face. But yeah, it'd be interesting to see if that's good enough. You know, you can't do we can't even do the elbow bump here, let alone the handshake.
I think there's a lot more that can be done virtually, to be honest. Just in terms of sort of our DD processes, we haven't really seen a change. We're closing a couple at the moment. I mean, I guess it's a seed raise, so it takes a little bit quicker than the other raises you've been talking about. But we try to always do it in sort of 6 weeks, 6 to 8 weeks. So there isn't really a change in that. I guess we are doing more, as I said, virtually rather than in-person pitch sessions, in-person screening. But I see some of that we can do virtually more on an ongoing basis going forward. Just on eligibility criteria, I wouldn't say that we have changed that either. I mean, we're still trying to back a scalable business model, the founding team, management. Is it a market opportunity? What I would say is there's more questions around, as I said before, how does this current scenario affect the company's ability to go to market? How can they best, conserve and manage cash flow? We're working a lot with our own existing portfolio companies at the moment, trying to support them where possible around managing cash flow. And what I would say is that if I was an early stage startup founder, I would be also being across all of the government support that is out there at the moment. And, Startup Oz has been great. The AIC has been great, championing, as Cameron said, I don't think the government's yet, but early repayment of R&D tax incentive payments, but there's lots of other things. Contact the ATO around the JobKeeper payments. Obviously, the criteria around have you experienced a 30% drop in turnover? I mean, if you're a pre-revenue startup, or a newly established business, you can't necessarily meet that, but they are going to, or have said they're going to apply discretion to companies that are in different circumstances. If you're a small company, in terms of turnover and salary bill, there's payroll tax relief. There's lots of other things sort of out there. So I would make sure that you're across all of those things.
Yeah, and various grant programs are also strategically pivoting to support startups and deliver additional funding. So accelerating commercialization, the advisors have indicated that, if you have something, a technology that may assist in various aspects of, COVID response, whether it be telehealth on one end or, whatever it is, a supply chain solution, they would look to target sort of funding there, but also look to deliver a sort of a larger quantum, potentially, of funding to start to ensure that they can get through these next couple of months, knowing that the commercial outcomes being a future cap raise will be a little bit off in the distance. So I think that and a lot of high net worth individuals who are investing, we found really want startups founders to at least know what grants are there in the ecosystem, because there are quite a number. There's about 7,000 grants, of which at least 500 of them are sort of immediately related to startup ecosystem or to sort of scaling companies. So and they can be sector specific or innovation specific or regionally specific. So a grant that just closed, although it's just been given an extension tomorrow, is the Female Founder Grant. Obviously, it's going to be very well subscribed because the website crashed, which is why they've extended it to Friday. But that's an example of a really fantastic program, which can support very, very early stage startups with up to 480K in funding, and should be closely looked at by startups, because you can even go for 25K funding from that program. So if you're looking just to do a proof of concept or a pre-MVP model, then that's a program that is worth looking at.
Sure.
But I was just going to say, in terms of the new ways of working, we're not seeing any sort of fundamental change. We've sort of been an online platform for a long time. The startup community in particular is, the digital natives on the whole. So we're continuing to sort of fund, pretty large sort of funding allocations, and just continuing to do it online. All the resources are there. Zoom's just become an extension of the way we work. So for us, we haven't noticed much of a change at all. It's just business as usual, and our customers have been online for a long time, so yeah, no fundamental change from our end.
Yeah, Steve, in terms of the way investors on both Wholesale Investor and CRIISP work, CRIISP, people make investments via the platform, or is it still just that's the introduction and then they
no, they can do applications on the platform.
So you're anticipating, so the investors that make investments via CRIISP don't directly meet the founders?
So it depends on the actual companies. So typically they can do the transaction on the platform, but often they will have an offline meeting as well. So what this is really interesting, like I know for myself, we had 10 different shareholders come on in the last 12 months. And I was thinking about for myself, 4 of those I've actually never met before, right? In my own scenario. So I know that high net worths can actually invest in and will follow a company for a period of time and have got some sort of comfort in investing in a company they've met. And they've been typically good at drilling their processes through using, Google Meet or through using Zoom and so forth. So that part's not it's more understanding that the larger transactions typically have some sort of face-to-face out. Like you've got investors that will fly to different countries to go and meet with, you've got companies that will fly to different countries to go and meet potential investors to have those conversations. I've done it. I'm sure other founders have done it. It's how does that impact going forward is the real interesting question. And will investors get the comfort level to basically be doing sort of, you talk about larger size, $1 million and above size investments if they've never met the founder. The 50 and 100K or maybe even up to 200K is possible, especially if companies have been around for some time and have actually got some sort of visibility or have had some sort of media awareness, or people at least feel comfortable that they sort of know the story of the company, know the background, and know how this company can handle the current situation. It's the ones that they haven't met before, the ones that they don't know, that are currently unknown to them. So they're the questions that we sort of have for, that we're wondering about.
Okay.
We do check sizes up to 6 million. So to answer your point, Steve.
Debt's all right though. It's equity. Debt's all right. I'm cool with debt could be done. It's more the equity part.
I think equity can be done as well. I mean, ultimately, how long are we going to be in this, remote working lockdown scenario? Ultimately, if you want to invest, you have no choice. So you can sit it out and think, okay, at some point you can meet people, or you want to get a deal done, you'll do it remotely. Ultimately, the reason you want to meet face to face is you kind of want to have that body language of meeting someone. You get that to an extent over a video call. Yes, you can't walk around the facility and check things out, but you can meet multiple people in a team over the internet. You can, diligence all the material in exactly the same way. You just can't physically touch something. So I think ultimately deals will be done remotely if they need to. If things loosen up and people can meet, then they will. But I think, if someone wants to do a deal, I'll do a deal.
Sure. I've just got some audience questions. One from Christy Mansfield. Just read this out. I totally agree with Lynda, and we're learning with customers that we can onboard and train people with our data platform virtually. We see this time as a huge opportunity. We're conserving cash and growing market share through our go-to-market pivot. We've also postponed our Series A. What would you suggest about when to embark on a Series A in the current climate? And given that it takes months to close a 2 to 5 mil Series A. So anyone's response to that would be awesome. So it's basically, when would be a good time to embark on a Series A in the current climate?
The reality is just my feedback would be is start now. Like I said, I'm sure you're on the same session that I was, where they said that after the GFC, the low of VC funding hit 12 months after the actual sort of Lehman Brothers incident. And that to me was an interesting comment that was made, and you can actually see it in the stats. So I think for any founder, if they're thinking about raising, even if they're going to raise a few months from now, they've actually got to kick off the process anyway, because it is going to take time. It's going to take longer. You're going to have to speak to more people. It's not like and I said people have this myth that raisings get done in 2 to 3 months, and they just don't. It takes longer to do that. The actual specific part may, but the actual end-to-end process can always be sort of anywhere from 6 to 12 months. Some companies just are continuously raising. So as far as when do you start having conversations today. Yesterday would be even better. As far as when you actually launch your raise, there's got to be some sort of momentum, whether it be you attract a cornerstone investor that's looking to come into the raise, or some sort of trigger situation that makes you decide to go, okay, yes, I'm going to go into the raise now. And if you look at good examples like the neobanks, right? Majority of the neobanks said, I thought that because I just saw Lynda, like obviously Volt's been successfully raising for a substantial amount of time. They can tell you how long it's taken and how many meetings and how many conversations they've had to have to raise their money. Same with, they've just gone from my head. You know, pretty much all of them, 86400. What's the other one? What's the business neobank? I forgot their name. Judo, sorry. Yeah, Judo is the other perfect example. You know, they were just diligently going around doing meetings and so forth. It's just consistent, diligent action of meetings with investors and just building up momentum. But as far as the actual trigger point, that's you know, the founder's got to make that call at the right time.
Does anyone
I think it's also stage based. So if you're really early stage, you do want to get maybe a keystone to sort of back you before you start, unless you're able to bring on investors in form of safe notes, which can be very good for the founders at an early stage. And the reason that is just the valuations are going to be depressed if you're bringing on cash, on fast now. I mean, we're seeing sort of 30 to 50%, lower valuations, and that's just, that'll change. But, it does take for the bigger deals, and bigger deals now are not 5 mil. Bigger deals, that's probably like anything above 1. It will take a longer time to kind of land that kind of cash. Sorry, Lynda, I didn't mean to interrupt.
No. I mean, I was just going to agree with Steve. I mean, I think it's starting to have that dialogue, opening up lines of communication, speaking to existing investors. You hopefully want them to follow on, but also you'd have your potential investor list of who you're wanting to approach next. And it will be, unfortunately, a longer conversation. I think I know there is fear of valuations being impacted given the scenario, but I think it's a conversation that you need to start. You need to start now.
Okay.
Yeah, if you have to raise a Series A, then you're going to have to do it. And I agree with everyone saying it's going to take longer, so start now. If you don't have to raise right now and it's in the future, really try and build those relationships early, because having a cold reach with someone you don't know in this market is going to be particularly difficult. So if you build that relationship over time, it's going to help you. If you're fortunate enough that you can knuckle down, extend your runway into next year and raise next year, then great. But words I've heard is the hardest point to raise is actually what Steve's saying, but the first half of next year is going to be really difficult to raise money because there's going to be pent up demand from this year. The funds that have money are going to have less dry powder, and it's going to be harder. So, I mean, the ideal is if you don't have to do an external raise, you can take money from your existing investors, which takes you through where you are now, and potentially use a convertible note to avoid a valuation discussion. Then that's probably the best thing to do.
Yeah, just picking up on that. Sorry, someone else jumping in?
Yeah, Peter, I was just going to agree with what Nick was saying. We're definitely seeing demand for our product and capital growing just because people just want to avoid a dilutionary impact now, just to strengthen their balance sheet as best they can so they can raise at the right time on their terms.
Cool. Yeah. So just picking up on that kind of a convertible note theme. What do people think about leading with the concept of a convertible note, speaking to investors? Is it something you should wait for them to present to you as an option, or is it something that companies should have as a strategy, trying to avoid a valuation now and postpone that until market improves? Do people have thoughts on that?
I think
yeah, I was going to Johnny, go on.
Yeah, look, I think that question's always relative to where the company is, who they're raising from, and how much they're raising. Look, I would invariably tell someone who's out there beginning the process of a round, talking to potential lead investors, to have the specific valuation and security as a bit of a question mark. Obviously, if you are doing well and there's a clear trajectory and you can substantiate your valuation, then simple priced equity is great. The spectrum of what is convertible and what is safe, or, you know, a lot of these different mechanisms for getting sort of the debt funding stuff that Nick and the guys do, you know, always be willing to have a conversation. Make sure you understand the mechanics and what the convertible really is about. If there's just a conversion set in the future at a discount based on the valuation, if there's a coupon, obviously be aware that if you need to pay a coupon at the moment, if you're having cash flow, then that can be difficult. Look, there are unfortunately some investors out there that might try and use a market like this as an opportunity to put in place some structures that are quite pecuniary or difficult to work with going forward, and might allow them to get more control and or more equity in a business. So just be very careful and mindful of how some of these deals are being structured. So getting back to it, you know, if you haven't sort of set a valuation or a price, you know, have it as a bit of an open conversation. Don't name something specific in your deck. If someone asks you, tell them what you think and what you expect. Be reasonable. Lead with what your expectation is, and then it might become a bit of a negotiation. And if it's within the realms of what you think is reasonable, and if it might be a bit of a discount given the current market climate, then, you know, be open and consider that. But, you know, it's always a bit of a two-way street, and unless you're a really hot startup that has people chasing them, almost never will you do a round where someone doesn't try and suggest that your valuation's too high and want to have a discussion. So you should always be ready and understand how that works, and if you are going to use some form of convertible or safe, you really need to be aware of what the future impact and dilution and potential risks are in getting into an agreement like that, and how that might affect the business going forward. So look, you just need to understand all these variables. You need to understand what you are comfortable with as you know, a business owner, founder, shareholder, and director of a business, as to how you can have a reasonable negotiation and discussion with an investor. And if someone looks as though they're trying to put forward something that you're not comfortable with, or seems a bit too convoluted or tricky at this time, then, you know, get advice or walk away.
Cool, thanks. Got some more questions here. How are investors treating startups in their current portfolios, particularly those that are struggling? This is from Ashley Aiken. Hi, Ashley. Another chap from Perth. So how are investors treating startups in their current portfolios, particularly those that are struggling? Can anyone speak to that?
Yeah, I mean, we've got, if I take a look at our portfolio at One Ventures, I mean, if I talk to our debt portfolio, we've got 5 companies in the portfolio. We've got a number who are doing particularly well in the market and actually seeing stronger demand. We've also got a company in travel, which is clearly not the best sector to be in right now. I mean, ultimately, businesses, I think, across the board, which aren't doing so well, it's really a question of what costs can you cut? How can you extend that runway? How can you get through this period? You know, and is that business going to bounce back out the other side and be positive? You know, given we're a lender, we're kind of less, I don't know how to put it. I mean, we're not the ones demanding those changes ultimately. It's really the shareholders making those choices. But we're helping guide people to be lean, you know, bring down that burn, extend that runway is kind of key things. But I think some conversations that I've had with equity investors, ultimately they have to make a decision, which is hard. So if a business is really struggling, it's kind of, is it struggling because of this very short-term, you know, COVID-19 impact, or is it struggling because actually the market demand is now going to be reduced if we head into a recession, and therefore it is a viable business? So I think investors are having hard decisions on whether to support businesses. The businesses they like and see long-term prosperity, they'll invest. So it's kind of amend your business and then make it work for that investor.
Does anyone else want to add anything?
Peter, I'd just say from our perspective, like we exclusively focus on someone's R&D tax refunds. So for us, that's all we're exclusively focused on. So for us, the eligibility hasn't changed. So if someone has a tax refund that is eligible, for us, we're there to fund it. So that our criteria hasn't changed because the R&D tax incentive plan hasn't changed at all.
From every investment group we've spoken with over the last sort of few weeks, they're either doing one of two things. They're either sort of doing their best to support their existing portfolio companies, even the sort of, let's call them problem children at this moment. How they are doing that is sort of all varies, but the other part they're doing is they're also going all in on some of their sort of potentials that have sort of that can become the sort of star performers sort of coming out the back end of this. So don't forget that part. There's the problem children that have to sort of, support and look after, as well as the ones that are going to sort of perform and do well.
Yeah, and from our perspective, like our portfolio, it's not an investor portfolio, but we've invested a large amount of pro bono time across the sort of 112 or so companies that are in our stack, and that includes just bringing in experts, not just from within the firm for free, but also right across the ecosystem, and bringing people across, because there are a lot of ex-founders and a lot of entrepreneurs and investors who, they really want to keep the ecosystem alive. And so I would say, if you're a founder and you're in trouble, like, reach out, because there are heaps of people in the ecosystem who, are willing to provide, free advice, even get, down in the trenches and help out, just to kind of, for a few hours a week or something, just to keep, because we're all here to make sure the ecosystem sort of gets through the next couple of months. So I think that's something to really keep in mind. And then try and to reach out when you need to, and also try and connect each other.
Yeah, and just leverage those government incentive programs, the grants that are out there. The government has just made some really big statements around JobKeeper and loans programs. So familiarising yourself with those to do anything to extend your runway to get to the other side. That's what these programs are there to do.
There's a lot of devil in the detail as well. So, like, there's 150,000 instant asset write down, which if you're using it for an R&D activity, then you can, get your cash out, and you can get it out early, with Cameron. So it's kind of like, just trying to piece together how all the incentives that are in the market, how you can sort of piece them together to build up your sort of roadmap.
It's like the unsecured loan program that's been rolled out as well. There's another sort of incentive that you can get behind as well.
Cool. Got a question here which is about collaboration. Just wondering if there's enough collaboration between angel groups, VCs, and funds to sufficiently fund startups, and whether now is an opportunity for, I guess, more collaboration. So, is there enough collaboration currently, and is now an opportunity to address that?
It's sort of a hard one to answer. Like, I don't know what good collaboration looks like, and what sort of, so there's not really, everyone seems to do their sort of own thing. Like, the industry is pretty sort of fragmented, with everyone sort of trying to champion their own sort of initiatives. So you don't really see, like, I haven't seen that much sort of collaboration across the two. But I think, as far as the time period goes, this way, how much people are working to support the ecosystem is probably the best that I've seen it, and that's the sort of things that you really want to champion. Is there enough? No. Well, the reality is no. There's never enough until everyone's absolutely working in perfect alignment with each other, and proactively supporting. Where you've got sort of angels, VCs, industries, each working in collaboration behind every single company to make sure that they're funded and all that. Like, I just haven't seen that sort of utopian world when it comes to this area. So I'd say the answer would be no, but I haven't really seen, what a perfect environment looks like. But probably this is the best. This is the most collaborative that I've experienced from working with different parties to try and sort of, at least sort of promote and create as much visibility as possible during sort of unusual circumstances.
Okay, thanks. Look, one more question, then I think we might start to wrap up. Now, this is around, I'll just rephrase this a little. With the current environment, founders aren't able to travel as much to see potential investors. You know, they're potentially saving a lot of money there. So the question was around whether this travel is seen as an investment or a potential waste of capital, where the contact can be done remotely. Do you think what we're going through in the current environment might lead to a change in the way that investors are open to see companies not in person, face to face, but greater use of the sort of mechanism we're using today?
I think it's pretty clearly a reset of how we do business. So yeah, absolutely. I'd say face-to-face still has very much a part to play, but this is a reset on how we do business in the immediate and long term, in my opinion.
So I think it's definitely forced some people to realise that you can always do a lot online. For instance, we're currently raising money, and we've got some investors we're speaking to out of the region. I was traveling in December, and then I was traveling right before everything sort of got locked down. I actually flew back in on the Sunday before midnight. The quarantine measures were put in place. And look, it's a bigger relationship than just some investment and potential partnership and some other things we're looking at with these investors. And always will be the case with where there's particular depth or relationship where invariably it's all about trust, which most relationships in business boil down to. There is always going to need to be some form of human interaction at some point. Whether that can be delayed or whether there's less of it, or instead of flying back up there to finalise a deal, I might be able to close it remotely. These are all practical new world considerations, and I think people will be a bit more accustomed to relaxing some of their old standards. Look, there's still some old white men with deep pockets that will probably say they meet them face to face and shake their hands. And that probably won't change ever. So, I think that's always going to be part of it. And even our model, which is predicated off online digital investment, where the vast majority of it does happen digitally, there is always a demand or a sort of a need for an actual proper human interaction and meeting face to face when people are writing bigger checks or forming deeper relationships. So, look, things will change. This will be a good sort of shift, and people will understand what can happen. But you can never truly replace human interaction. And as a single bloke locked in an apartment by myself that's not getting to interact with my staff or my customers, it's impacting me and my productivity and health and well-being. So, I think there is a lot to be said around how you really understand people, and particularly when you are talking about trust, which is what investment boils down to, you will always need an element of face-to-face.
Yeah, absolutely. Okay, well, we've only got a couple of minutes left. Everyone has a busy day to get on with. So I'd like to end on a positive note. What are the good things that people see coming out of this whole interesting time we're in terms of startups and investments and funding? Anyone want to jump in on that?
I'll have a crack. I think in some ways it's making people be braver and embracing some very obvious things like telehealth, which has been fighting for currency and relevancy for a long time, yet it's been a very relevant way of delivering health solutions. So it's actually forcing us to do things differently and to be braver. So I think those startups or this group's been supporting for a long period of time are now actually getting cut through that they deserve. So I think for many of the businesses that we support day to day, there's more potential for them that once was available to them prior to this event.
Cool. Look, just like to jump to Lynda, because I know that you've got another call that you had to get to. Is there anything that you wanted to close with?
Look, the only thing I would add is that, you know, whilst these are challenging times, I think there are some positives to take from it. I think, you know, it's a time for businesses to sit back and really focus on what's their core purpose and how do they deliver that in you know, a challenging environment of managing cash flow and raising capital. But, you know, these ways of working, you know, there's companies out there with distributed workforce, distributed board, distributed investor base. You know, it's a reality of how do you interact in a virtual environment and still get things done, which I think is really possible and is hopefully at a lower cost. I agree with Johnny to an extent that, you know, there are some things around physical contact you can't replicate. There are investors that want to look you directly in the eye. There are, you know, just day to day, you run into people in the kitchen and that's kind of where you learn something and you find out what the hell's going on. But, you know, equally we are where we are. And I do think that there will be ways of working that we take forward from this. Anyway, I'm really sorry I do have to go, but thank you very much. And yeah, hopefully see you physically soon. If not, talk soon. Okay, bye.
Thanks, Lynda. Nick, perhaps, is there anything you wanted to add?
No, I think the only thing really that I think good coming out of it is just what you're saying in terms of this is a time which really tests founders and tests people. I think ultimately, look, it's a real curveball that's been thrown at people and people weren't expecting it. So I think tough times make people push people to, not to limits per se, but push them in terms of adapting to change, which is a good skill to have. I mean, look, a lot of founders haven't seen the bad times. It's been, you know, bull year after bull year. It's great times, easy. You know, you can easily raise money. You can have loads of fat in your business, and it's fine. This kind of tests you to make sure that your business is, you know, focused, aligned, and you as a person can kind of develop from those, you know, from those learnings.
Pete, I've actually got a question for Nick. Given venture debt is a relatively new concept in Australia, and you know, even to us people in the equity world, you know, obviously you look at cash flows of businesses and you want relatively stable, established, high growth businesses that you can understand that dynamic. When you're interacting with companies at the moment, how does that change your lens, and how do you build in different ways of looking at the current and future cash flows and how they might change? And does it change the deal structure you guys are talking with companies? Are you just lending a little bit less initially? What's really happening with how you do that?
Sure. So we're really happy to lend to cash flowing businesses, and we don't have requirements that you must become cash flow positive in a certain period of time. So some lenders out there say, look, you've got to become profitable in the next year. And obviously this market's going to make that more difficult. So we're not necessarily looking at things like that. I mean, ultimately we want to see the business being a bit more resilient. And I mean, ultimately, if we look at their unit economics, we want to make sure that things are trending better. It can survive through this, can be leaner, it's got a longer runway. So we'll look more deeper under the hood, I suppose, and then be more selective in the sorts of businesses we may or may not want to lend to. I don't think it necessarily changes. We're not looking to suddenly change our terms and suddenly price things much more expensive. That's not really the intention. I think ultimately our facilities change slightly in this market. So people may use the money as more of an insurance policy as well. So what we can do is we can put in place facilities which are available and people can draw them down in the future if they need them, which can work quite complementary to potentially a convertible note from the investors. So it's kind of combining and seeing how that debt fits in with the current financing needs to then take you forward. But ultimately, like any investor, if I look at ourselves as an investor, we will be more selective. You know, are we going to suddenly lend to a travel business right now, business hospitality? Probably not. But does that mean in 3 months' time, are we? I mean, people are still going to go to restaurants and cafes when we come out of this. People are going to start traveling again. So they're short-term disruption, but longer-term viable. So it's really around how we approach those deals. But I think venture debt, like you say, is very new in this market, but it still has a long way to grow, and I see it growing even through a downturn.
Cool. Any closing comments from anyone else? We're a little over time, but I'll if anyone wants to add anything, that'd be great. Johan, maybe?
Yeah, I mean, I suppose that one of the really interesting big trends that we're seeing is that especially some of the strategic investors that I know work with Macquarie and some in the banking space, you know, like the oil prices crashed, you know, it might come up again, but really, like, most investors are seeing the world anew and looking at, you know, how will the world change, and how can we be a part of that change, right? So it's if you've got a product or a startup that's like really looking at that kind of change the world space in clean tech, in social impact, where that changes can be scaled and deliver, you know, a new world, then I think that will have a lot of traction. And, you know, some of the companies that we saw coming out of the GFC, you know, they really changed the way that we thought about, you know, everything from payments all the way through to, you know, the way precision medicine. So I think we will see some really interesting companies come through this, and I would, you know, get founders to kind of think about how, you know, what does that big picture view look like?
Exciting stuff.
Just practically, I'll just say, be diligent, be visible, be aggressive, and just know that whatever you're planning to do is going to take longer, and you're going to have to work harder for every single inch that you get. And if you're not already working 12 to 18 hours a day, you should be looking at, especially for the founders, right? They should absolutely be doing that, because they have to take advantage. They have to create their own opportunity out of this market. No one's going to give them anything.
I would just temper that with remember, this is not a sprint, it's a marathon. Yes, work hard if you have to, do what you can to be inventive and resourceful, but don't kill yourself, because guys, it's obviously very stressful and difficult times. Don't feel as though you need to come up with a solution. Maybe working out a way where you can trim your business back to being 70-80% of what you were doing before this, and you can come out the other side and sustain things and cut back on costs, is the best outcome. Not everyone's going to be able to pivot or do adjacent things. So yeah, if you can work hard, don't feel the need to work hard.
Okay, cool. Well, look, I might close off there. We're a little bit over time. We have been recording this, so it'll be available. Would love to get people's feedback after the event, and so I'll shoot a survey out. Also, well, I won't bother about additional Techboard promos. We've got some interesting products that will hopefully be coming out in the valuation deal pricing space, but we haven't got those ready yet. So more information on that later. I'd like to thank everyone for their contribution this morning. Thank the audience for coming along. And I hope everyone is well and stays well, and best of luck for the months ahead. And
thank you very much, Peter.
Thanks, Peter.
Thanks very much, everyone.
Thank you.
And have a great day.
Yeah.
Okay.
Thank you.